You're now listening to the Supply Chain Secrets Podcast, the ultimate insider's guide for all things ocean shipping. Brought to you by Kaishex, helping you deliver through volatility.
Hello, everyone. Good morning. You're listening to the Supply Chain Secrets Podcast. I'm your co-host, Caroline Weaver, and with me is Lars Jensen. Lars, how you doing?
Morning. I'm doing great. Calling in from, I was about to say sunny St. Vincent in the Caribbean, but actually it's raining now. Hopefully it'll clear up.
Typical for the Caribbean. You have to deal with a little bit of rain to get the nice sunshine, huh?
Yes.
All right. Well, let's get started talking about rates. And specifically, let's start talking from where rates settled on Friday. So let's start with Asia to North Europe today.
Yeah, I mean, if we start out looking at the settlement rates for the night buy, it settled this time at just over 2,000, actually 2,039 reported for it to be precise. It's up about $49 compared to last week. So clearly a slight increase, but as we can also see here on the graph in the wider context, it is not that massive of an increase. What it also tells us is that the turmoil we're seeing from the Hormuz has yet to manifest itself in the actual settled rates. That is something we will see over the next coming weeks.
Yeah. Okay, switching gears a little bit, talking about Asia to US East Coast. Can you tell us about where we're at here?
Yeah, on the Asia-US East Coast, what we see here is rates are actually down slightly. Again, as we talked about on Asia North Europe, it's not that the changes are massive, but when we look at the differential compared to last week, we do see East Coast rates down some $27. For most shippers out there, a change in the settle rate of $20 to Asia-US East Coast is, well, pocket change might sound the callous, but compared to the changes we've been used to in the market, this is actually relatively benign, relatively stable. As we can also see here on the US West Coast, also very, very marginal changes. In this case, it's a tiny increase in the overall West Coast index, where the settle rate now came up at $1,780 per 40 foot, which is just $23 up compared to last week. So at the overall level, it seems things are fairly stable and benign. But I think where you want to take us, Caroline, is to look a little bit below the surface where it is not as stable as the overall index might suggest.
Yes, so I have the different subtrades for China, Taiwan to US West Coast, Southeast Asia to US West Coast, and Northeast Asia to US West Coast. And we're seeing quite a bit of a spread, but when I was looking earlier, I noticed in the last 90 days, for example, you can see where there are certain weeks where the rates really converge, and there's not much of a difference. Looking at February 20th of 2026, the rates were all kind of hovering around 1720, 1710. But if we look today, we can see that the rates are quite different. We have a spread of about $250 between the different subtrades. I was wondering if you could talk a little bit about why that might be happening.
Yeah, because it's a phenomenon we've seen before. And yes, it is quite a spread between the subtrades. If we go even further back in history, we can even see it in the graph here. We've seen larger spreads before. I think one of the key drivers everybody needs to keep in mind is for this Trans-Pacific trade, it's China to US that is the major driver in terms of where is capacity deployed. That means that capacity deployed out of Southeast Asia, out of Northeast Asia, has a significant overlap with vessels also calling China. And depending on how the carriers change the allocation of this capacity between China, Northeast Asia, and Southeast Asia, this could lead to significant changes. Of course, demand changes out of either Northeast Asia or Southeast Asia can also result in this, but very often the root of it is carrier reallocation of which countries or which regions get the capacity in any given week. So that's why we see this fluctuating up and down. The overall pattern that we need to be aware of here is most often, not always, but most often, it's the China to US West Coast rate. That's the lowest. Then Northeast Asia, Southeast Asia usually trades at a little bit of a premium compared to the China rate, not always. But for Northeast Asia and Southeast Asia, it varies over time which ones of them command the largest premium. So it's kind of like, no, this would be the wrong metaphor, but I was about to say rearranging the deck chairs on the Titanic. I'm not implying that the overall market is going down. Absolutely, it's not. But it is an overall collective pool where China is the driver, and then you have additional capacity that can be shifted back and forth between Southeast Asia and Northeast Asia.
Okay. So would you say that when there's more capacity in one of the regions, either Southeast or Northeast Asia, the rates are lower then, typically?
It tends to be the case because it tends to be either it's Northeast Asia or it's Southeast Asia that commands a premium. That's kind of the pattern we see unfold.
Okay, gotcha. Thanks for walking us through that. I also wanted to cue our listeners into the forward prices of freight. We've mentioned that a little bit on the podcast before, but I thought it would be worth sort of doing a deeper dive into the forward prices. And when I say that, what I mean is what the market thinks the price of freight will be at a point in the future. So if we have Asia US West Coast here, so we can see how the rates are expected to increase throughout the year. Could you talk a little bit about this?
Yeah, I mean, if we look at where we are now, the settle rates here just before the weekend was at $1780 per 40 foot. If we look at the forward rate, it's set to increase to a peak. In this case, the expectation is 2,650 US dollars by October, with a gradual increase over time. This is what the market believes is going to be the case right now. And of course, that's about an $800 increase per 40 foot compared to where we are now. That's currently seemingly priced into the market. Is that a lot or is it a little? Well, there are several ways to look at it. One thing is if you can maybe expand the time frame a little further back. What we can see here is the expected peak of 2650 is nothing compared to what we saw last summer. But let's also be real, the peak we saw last summer, that was driven by the very rapid changes in the China-US tariffs, with a lot of cargo that was waiting out of China. We then had the sudden surge, and that bubble collapsed just as quickly as it actually arose again. So the increase we're looking at towards summer is, of course, nowhere near that. What we should also keep in mind, though, is an $800 increase between now and October is actually not that much of an increase. If we look at some of the emergency fuel surcharges carriers are already out announcing, they would account for roughly half of this increase, just that on their own. That's under the assumption that doesn't change. But it is interesting to finally be able to also get some market insights into where is the market believing these rates are going to go.
Definitely. Let's take a look at Asia US East Coast. So a similar
Asia
story
US
here.
Yeah, it's a similar story. The only thing we should be mindful of here is the market actually expects a much larger increase here than what we expect to the West Coast. In terms of settlement rates, we are now just a hair's breadth short of $2,500, but the market expects this to go to $3,600, again, with a peak coinciding with the usual peak season, so a peak by October-ish. That's an $1,100 increase. That is compared to what we saw before, where the market expects an $800 increase into the West Coast. So anyone shipping on the Pacific, these are likely some of the increases, at least they should begin to plan for and contemplate in their supply chains.
Lastly, let's take a peek at Asia and North Europe.
Yes, the story is almost the same. Of course, we didn't see the extreme spike earlier in 25 because Asia and Europe is, of course, not subject to the China-US tariffs. We did see a spike. All of that was derived effects from the trade war, but not to the degree we saw in Pacific. The peak that we are now expecting to see in the forward market here is only $600 up compared to where we are now. It's a peak around 2650 per 40 foot in September and in October, as it is right now. Slightly lower than this massive trade war-induced peak that we had in 25, but still quite an increase. However, as I also mentioned, if we look at the emergency fuel surcharges that the carriers have announced, they would likely account for at least 2/3 of this increase. So the open question is whether the market expectations here might be too conservative, whether we are likely going to see these forward curves potentially shift upwards going forward, especially when we see what is happening in relation to the Strait of Hormuz.
Thank you for walking us through that. I think it's probably good to take a step back and talk about where we're at with the broader news. We talked about the forward prices and sort of at a high level what might be impacting it, but I think it would be good to talk a little bit more about, where things are at with the Iran conflict. Where do you expect the freight rates to go? Maybe it's not as high as some people might expect. Tell me a little bit about what you're thinking.
Yeah, I think I've mentioned this in previous podcasts as well. We need to think of this in different time levels. Where we are at now is, and this might be something a lot of people don't want to hear, but we are at a point where we need to start thinking seriously about the question, what if this becomes semi-permanent? I think most people are hoping that is most certainly not the case, that somehow this is going to be resolved in the short term. Let's just deal with that one first. If this is resolved in the short term, for whatever reason, then within the next week or two, everything goes back to normal. The Strait of Hormuz is completely open, no more problems. The main ramification of that one will be on the container side. There's quite some congestion issues that needs to be resolved from cargo being dumped in the wrong places. That can be managed. In terms of fuel prices, we should expect elevated fuel prices likely to persist for a long time because we haven't really exported any oil out of the Middle East for almost a month now. That is going to lead to shortages elsewhere down the stream. Remember, the supply chain for energy products is very long. I mean, ever since the Hormuz closed, we have still seen tankers arriving at refineries, but these were all tankers that left the Strait of Hormuz before the crisis. So we're going to have a gap. There is going to be an impact on cost that will range for months in the system, no matter if it gets resolved quickly. Now, back to the other question I then asked. Should we start to think differently about this? Let's everybody take a time voyage back to around New Year 23-24, where the Red Sea crisis had been ongoing, at least on the container side, for a couple of weeks, for the wider market at that point in time for about a month and a half. This was also the point where it began to dawn on people, maybe, just maybe, this is not going to be resolved quickly. At that point in time, there were also considerations out that there is no alternative. We have to go via the Red Sea, but yet we had to find an alternative. And I think that might also be the point we're at now. We need to think seriously about what happens to the markets if this situation persists. Maybe just to break down what I mean by this situation first. Doesn't necessarily mean that we're going to see a continuing shooting war all the time. Just like in the Red Sea, we saw a significant tapering off of the activity of the Houthis. But you don't need to shoot all the time to make a credible threat that de facto prevents at least a significant number of shipping lines to go through a strait. And the semi-permanent situation that could arise in Hormuz might be more or less the same, whereas some ships and shipping lines are allowed to go through, some are not. That will reduce the amount of capacity available, just like the Red Sea reduced it. That will lead to a number of different things. On the container side, the simple part is it will just mean some of the cargo will have to go overland through Oman and Saudi. We don't have enough intermodal capacity to do it, so there's simply some cargo that won't move. That's one part of it. The other part would then also be there will likely be container shipping lines that will be allowed to go through Hormuz. If they are not seen as allied with US or Israel and part of the conflict, that's where Iran seems to be heading, at least for now, that there will be some shipping lines allowed to go through. Then there's a discussion point whether you would need to pay Iran a toll to do that. Some of the market rumors right now indicate that that might be the case, but there's nothing confirmed. And from that perspective, the situation would be identical to the Red Sea, where you have a reduction of capacity available to go through. The implications, the consequences of it would be very, very different than what we see in the Red Sea, though. The implications for the Red Sea on container shipping were absolutely global because we had to go around Africa, and that removed all the excess capacity and caused freight rates to spike. From a container shipping perspective, this is a regional problem. It's not a global problem. On the other hand, what the Hormuz constraint, let's call it that, would mean is massive upwards pressure on fuel and energy prices, which of course has massively global implications. If that becomes a semi-permanent state of affairs, that will drain a lot of money out of the global markets. Consumers will have to spend a lot more money on energy. And energy is not just when you buy gas down at the pump. It's heating your house. It's all the energy that goes into producing all the goods that you would like to have. And let's not forget, AI is an extremely energy intensive industry as well. So this is going to have cost ramifications everywhere if this becomes semi-permanent. Where's that money going to come from? One of the elements might be a reduction in consumer spending. And a reduction in consumer spending will inexorably also lead to a downward pressure on container demand. So if this is what we're looking into, we could also suddenly see container demand growth become a lot less than what we expected towards second half of this year. And if that is the case, then we end up in the situation again here, not looking at the tanker markets, but looking at the container markets, where on one hand, you will have container lines facing rapidly increasing bunker fuel costs. At the same time, we might begin to face overcapacity issues. Otherwise, we wouldn't have seen overcapacity issues this year, especially not when we still go around Africa. But if demand is negatively impacted, this could actually begin to be the case. So we're going to end up in a market which, on one hand, has an upward freight rate push because there's a need to pay for these massive increases in bunker fuel. At the same time, a downward pressure from supply demand. So from that perspective, when we look at the forward curves now, they appear to be some sort of a balanced view between a sharp upwards pressure stemming from fuel, but a potential negative force acting from a drop in demand itself. In any case, it is extremely hard to call how exactly this will play out. But I do think it is a necessary discussion that all market stakeholders have to have with themselves and their collaborative partners. What if this becomes semi-permanent?
Yeah, I think it's a very fair assessment because at first glance, you would kind of expect the future rates to be much higher than they are. But I think your explanation about consumer demand potentially blocking that from going too high is a fair one. We've talked in other episodes about the demand patterns that we've seen lately, especially from the US. We've already seen demand decreasing over 2025, early 2026. So if that continues to go down, I think you're onto something here that you might have your rates might be tapered a bit by just people not buying as much stuff, so things don't need to be shipped.
Yeah, and again, it points to also why it is of interest. We've discussed this in previous versions of the podcast as well, that if you look at your supply chain and find out, I don't want to live with this extreme uncertainty, what can I do? That is exactly where some of these index-linked contracts in combination with hedging then comes in. You may not necessarily like where you can then lock in the longer term rates, but it will guarantee you that you know at least what you're looking at in a world where there's very, very little certainty for the coming month.
Definitely. And one last thing I wanted to ask you about. So, when you talk about cargo insurance for these vessels, does that rate fluctuate over time? Like, would it be that that rate becomes higher the longer this war goes on? Or do you think that the start of the war is sort of the peak of what that increase in insurance would mean for the carriers?
I would have a suspicion, at least, that right now, insurance premiums, to the degree you can even get them for ships going through the Hormuz, is at the highest level right now. If we then begin to see this gradual reopening, it is, of course, a question to which degree you can even get reasonable insurance to go through. I wouldn't say under Iranian protection, but at least allowed by the Iranians, because this is de facto what we're looking at. If you look at how the Hormuz has played out over the last week and a half, we are seeing an increasing number of Indian vessels going through. And that has also been confirmed by the Indian government that this is an agreement they have with Iran. Iran has been pretty clear saying that they will leave the strait open for vessels from countries that are not allied with US and Israel. The gray zone here is always, how do you assign a nationality to a vessel? This was also what we saw early in the Red Sea. Because is it the owner? Is it the operator? Is it the major shippers that are on board? Is it the ship management company? Is it the flag? So it's kind of fungible. So it's probably more a matter of, if you have a ship you want to set through, you might want to check it with whoever you check it with over in Iran to make sure you don't get shot at. What I think is interesting here is, if this is the direction we are moving, at least for now, this would place most Western shipping lines in the category that they cannot transit. But it also places most of the Asian shipping lines in the category where they are likely to be able to transit. And from a container shipping perspective, this is interesting because we both have some Western and we have some Asian container lines. And if we begin to see a potential opening for some of the Asian ones, this will skew the competitive landscape to and from the Gulf.
Very true. A lot of variables at play here. Well,
A lot of variables play. And again, if we just go back to the shipping lines, what I do not expect to see is shipping lines, even if they're in the category of getting, I was about to say, a safe passage by the Iranians, and regardless of whether they paid for it or not, I don't see anybody being willing to risk really large container ships doing that. I mean, that's also what you saw in some of the services into the Red Sea. Most of these would likely be smaller regional vessels, not the ultra large container vessels.
Yeah, that makes a lot of sense. All right, Lars. Well, I think that's probably enough for today. We'll give our listeners a break from all the chaos. But be sure to tune in next week. We'll have a new episode for you. If you haven't already subscribed, be sure to. We're on YouTube, Spotify, Apple Music. Until then, have an awesome week. Bye, everyone.
Thanks for listening to the Supply Chain Secrets podcast, presented by NiceX. Be sure to subscribe on your favorite podcast app.